This is Trepp Wire with a special guest podcast, Managing CRE Risk. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today, Dr. Eva Steiner, Associate Professor at the Penn State Smeal College of Business. Welcome, Eva.
Thank you for inviting me.
Absolutely. Give a quick overview of your background for our listeners.
Sure. So I'm Associate Professor of Real Estate at Smeal, where I teach real estate finance and investments to undergraduate students, graduate students, and MBAs. I only joined Penn State last summer, and prior to that, I taught at Cornell and at Cambridge in the UK, and that's also where I started as a researcher. And before joining academia, I actually worked in the real estate investment industry, most recently at LaSalle Investment Management in London.
So let's jump right into it. You co-authored a study, The Rate of Return of Real Estate, that had some pretty interesting insights. What were the findings, and what do you think are the potential takeaways for commercial real estate investors?
Yeah, so that was a study that I co-authored with David Chambers from Cambridge and Christophe Spaniers from HEC Paris. And the main finding of that study was that real estate, and in particular housing, so residential real estate, is actually less profitable of an investment in the long run than we used to think. And our work suggests that there are really two key factors that drive this result. First is that it's very important to control for improvements in the quality of the real estate stock when you estimate aggregate rental growth in a market. Because if the quality of the local real estate stock improves, then rents necessarily increase on average, but any individual investor owning a given property may not experience the same level of income growth. And the other really important factor is holding costs. So repairs, maintenance, property taxes, which are very significant in real estate. So if you ignore those, then that leads you to overestimate net cash flows and their volatility. So if you ask me, what does that mean for commercial real estate investors? Actually, we make a point in our study that the performance of residential real estate is quite a poor proxy for real estate as an asset class overall, because most obviously you have other property types, agricultural, commercial. And while not as detailed, our data allowed us to draw some inferences about the performance of commercial real estate as well. And we estimate that on balance, the performance falls somewhere in between residential and agricultural real estate.
As someone who has owned some investment properties in my past, I can vouch for the holding costs and the repairs and maintenance and the underwritten net cash flows versus the actual net cash flows. Now, I don't know if, some single family rentals in middle America really count to this study, but I can vouch for that piece of it.
Yeah, I think it counts definitely, maybe not the exact numbers or shares that you experience, but the underlying principle that holding costs eat a big chunk of your gross income, that will certainly be valid.
Did you find a big impact from when the study was taken? Was there a big difference in performance from, shortly after the great financial crisis? Did people slow down their investment in these types of assets? Did it pick up after that? Was that an influence in any way in your outcome?
Yeah, so what was very interesting was that we looked at the composition of these institutional real estate portfolios in the long run, so over most of the 20th century. And so we're looking at UK university endowments, basically. So it's a particular type of large institutional investors. And historically, they have always had large shares of their portfolios in real estate. But if you look at the composition within the real estate asset class, then they started out heavily in agricultural, more in residential, and then over the course of the 20th century shifted more and more into commercial. So you see that as the commercial real estate asset class takes shape, which happened over the 20th century and probably in the more recent decades, institutional investors gravitate towards that type of real estate.
It's a very interesting point that you bring up about the additional costs that come in, because it is something that our listeners and our clients talk about all the time, which is what is defined as an extraordinary one-time cost and what is defined as something that should be baked in to the annual expenses of operating a property. And we've had this question come up before, that when people are coming up with underwritten net operating income numbers, they will debate what should fall into this. If you're replacing a boiler, once every 15 years, how do you account for that from one year to the next? And it's a very interesting piece, and one that's heavily argued, between investors and underwriters.
Yes, definitely. On that note, that just brings to mind great analysis by Green Street Advisors, who actually seem to take the view that, according to their data, a lot of investors tend to be too conservative in underwriting the amount of capital expenditure that's actually required in order to keep the condition of your building competitive, so that its value and the potential rental income that it can attract will evolve in line with the market. And I have to say that, based on our own long-term data, my conclusion was also that probably these holding costs make up a larger chunk of gross income than we would like to underwrite ideally.
It's interesting, the residential side has, other than in some major US cities and perhaps in Europe as well, and here in the US, we're talking really about San Francisco and New York, that part of the market has sidestepped problems over the last year. COVID has not been a real driver of distress, but you have done work in an area that is much more subject to distress over the last year, and that would be the hotel industry. You put out some research over the last month about that. Tell us a little bit about your research in that area.
So I'm working on 2 hotel-related projects right now. That is thanks to Cornell, my former employer, where the real estate group sits in the hotel school. And so we have excellent access to really interesting data on hotel operations and hotel real estate transactions. So I think the study you refer to is the study with Christoph Spaniers about private equity investors in the hotel industry. So for that, really the motivating observation was this ongoing debate about the value of PE investors. And we were looking at this debate and thinking about how we could contribute to it. And we felt that we wouldn't necessarily serve it or advance it by asking whether PE investors create value in any particular setting, but rather we kind of turned the question on its head, and it seemed more productive to us to ask kind of in what settings, under what conditions the PE model is likely to be a superior form of ownership, as the proponents of this investment model like to argue. And when we looked at the data, the results seem to suggest that PE-backed hotels do show some operating efficiency gains. But on the other hand, we found little evidence that PE investors increased capital expenditures or improved guest satisfaction any more than other hotel investors would do at the same time. But they very frequently actually replaced the incumbent management team. Then again, when we looked at their capital gains to PE investors relative to other hotel investor types, the higher average capital gains that PE investors seem to experience can be explained by their location choices. So on balance, if you're asking me, how can PE investors distinguish themselves most effectively and really drive outperformance over other investor types in this particular setting, it seems to be through their access to cheaper financing, which of course then boosts the levered returns for their own end investors.
So it's interesting. I really like this piece. It was quite both informative, but also counterintuitive, right? We think about PE investors running a tighter ship, right? That coming in and cutting costs and really driving value that way. You didn't really find that on your side of it. But on the other side, you would think that the traditional hotel operator would be laser focused on location. But that's where PE really made their inroads in terms of value add, right? Higher returns on capital. Can you go into a little bit more detail? Like, what would you say is the reason for those findings?
Yeah, so I interpret our findings through that lens of what do these findings tell us about the settings in which the PE model would be able to outperform, as you would expect, because they run a tighter ship, et cetera. But let's think about how investors create value in commercial real estate, and in particular in hotels, the setting that we study. is that on the level of operations in commercial real estate in general, you may increase occupancy or you may renegotiate rents. But in the hotel sector, you have to remember that investors most of the time buy a going concern where the operations are almost taken as a given because you hire a professional management company and they run the day-to-day operations of the hotel on your behalf. So here, the most effective lever would be to replace the management company if they happen to underperform in the past. And we do see PE doing that. Now then on the level of the physical asset, if you think again about how investors in commercial real estate create value, implementing capital expenditure projects, which is kind of the prime value add strategy where you improve the physical substance of the asset that you're looking at. But implementing those projects is costly and time consuming. So those projects tend to have a relatively long payback period. And in fact, that may just be too long for the relatively short holding periods that PE investors tend to favor. So what does that leave us with? It leaves us with stock selection. And here we see that, yes, PE investors do select assets in growing locations. And then finally, we see that PE investors do tend to benefit from better access to cheaper capital. So it seems that within the parameters of the asset class, and given the kind of asset management strategies that PE investors typically employ, the most effective one that they can employ in this particular setting seems to be through the financial engineering side.
Yeah, so I read through this as well, and I find it very interesting. My poor man's interpretation of this is that all else equal, a large private equity investor type looking at, let's call it a limited service hotel or something like that in a secondary or tertiary market would be likely, based on the stats, to underperform an investor with regional operational experience in that market, which kind of makes sense to me, right? I mean, like I don't want to name names, but if Blackstone or KKR or somebody swoops in and purchases a property, they're probably just leveraging their name and their financing and the fact that, they think that they can kind of engineer this in a way to juice returns, as opposed to a regional guy who doesn't have as good financing is going to have to do it on the operations side to make money, right? So that's kind of my interpretation of it. I may be wrong, but
no, I think you're exactly on the right track. And in fact, something that we're thinking about exploring more is looking at heterogeneity across different types of PE investors. Because you could imagine, kind of going off of the example that you just mentioned, you have a sector generalist like Blackstone or any other big PE firm, and they may focus on deploying a lot of capital quickly and making returns off of their ability to access cheaper funding. Whereas on the other hand side, you may have a smaller sector specialist that focuses a lot more on operations, maybe picks a management company that is a lot more prepared to work closely with the owner, whereas perhaps a larger generalist may just go with one of the large nationally operating management companies where if you sign with them, you get their management model. They don't take any input from you. So I think it is fair to assume that there will be some heterogeneity in the strategies favored by different types of PE investors and the results derived from those strategies.
One of the things we've talked about in this market, in the hotel market, has been that in a couple of areas, it wasn't solely COVID, which took a real bite out of hotel operators, but it was oversaturation. Places like Houston really oversaturated. New York City, Chicago to some extent, really had a glut of rooms even before the pandemic began. I have a thesis here, and my thesis is that as a private equity operator, you see a promising market, you come in, you grow value, you get out, and you're not tethered to this market for the long term. Whereas a hotel operator whose business is to own and operate hotels for long periods of time, they may move into an opportunistic market very quickly, but then they stay there while everybody else figures it out. And at the end of the day, private equity is gone and the hotel operator is still there. What are your thoughts about that? And have you done any thinking about, how that influences the differential in returns?
Yeah, so one observation I can offer on that question is that we looked at the types of locations that PE investors versus everybody else, which I'm going to call non-PE investors, seem to favor for their acquisitions. And over the 20-year period that we studied, it seems that PE investors are slightly more likely to focus on locations that are highly supply constrained. So an example like Key West or downtown San Francisco, where for regulation or for geographical reasons, there is just constraints on how much supply is likely going to appear there in the future. So I would say that my observation is that PE tends to be very judicious in terms of where to deploy capital. But then again, in terms of your observation on hotel operators, now hotel operators, of course, they hardly own, very few of them own substantial chunks of their real estate anymore. So they pick a location almost for different reasons than a hotel real estate investor would. For them, it's about broadening their network of locations so that their brand really saturates all of these, reaches all of these markets. And these motivations may lead them to make very different location choices that not necessarily any other hotel real estate investor would prioritize.
Well, very interesting. That's great stuff. And I really loved your research, and I look forward to your follow-up research on these topics.
So while we're on the subject of lodging in hotels, 2 rounds of the Paycheck Protection Program created a lifeline for many of these businesses that were forced to completely close during the pandemic. You looked at the impact that PPP loans had on the competitive behavior of hotels. What did that show?
Yeah, so this is new work together with Alexei Chisti from Cornell University. And here we have 2 interesting sets of results so far. First, we looked at which hotels chose to apply for PPP loans in the first place. And here we find that it was predominantly those that had weaker operating performance already going into the pandemic, those located in more competitive markets, and those located in markets that experienced steeper declines in demand. So that was very interesting for us to see in the first place. But then among the hotels that did obtain PPP loans, we saw that those businesses all of a sudden, like flicking a switch, started to compete a lot more aggressively, undercutting their non-PPP competitors on room rates to secure higher occupancy. So I think it is fair to conclude from the evidence that we were able to put together that PPP loans actually distorted competition during 2020. They were very beneficial for the hotels that received them, but they had negative effects on the hotels that chose not to apply for them.
Do you have any sense of reasons that hotels would apply for PPP or wouldn't?
Yeah, so our data analysis focused on drivers that would make a hotel more likely to apply. So those were their pre-pandemic performance, the level of competition in their local market, and also the degree to which they experienced a drop in demand. Now, why wouldn't everybody go for the free money that is essentially offered by the PPP program? That's a very interesting question. And we think that this comes down to almost reputation concerns. If you look back at what happened to executives that accepted on behalf of their companies bailout money from the government in the global financial crisis, there were repercussions in the end. And so there is actually research that I'm personally not involved in, but that I've seen recently that shows that similar concerns about potential future, I'm going to call it government clampdown, were reasons why some businesses hesitated to get these PPP loans. And even though they qualified, they eventually returned the money because there were these reputational concerns.
So we know, or at least we see anecdotally, and we hear from special servicers and so forth, that they're expecting a really explosive recovery in the second half of the year. And I would say if there's a bias, I think the bias is that vacation destinations will largely outperform offices in the early parts of the race to recovery. Separate from your research, what are your thoughts about the hotel market right now, and where do you see it going over the next couple of years?
In the short run, I have to agree with you that probably domestic vacation destinations, kind of resort destinations, are going to do very well, because I've just recently seen figures that I think 75% of Americans are planning to go on a vacation this year. And those are the same Americans that postponed going on a vacation last year for obvious reasons. And I think 2/3 of Americans have already booked trips. I can tell you from my own experience that trying to find holiday accommodation right now is really difficult and really expensive. So I do think that there is some truth to that. I will say that in the long run, this is actually a really interesting question. So our study on PPP loans actually focused on airport hotels. And those are very interesting because they're in very particular locations, not necessarily, I mean, in some airport markets, they are basically downtown hotels, but in others, they are literally by the airport. So there is a question about what will become of those hotels, especially if you consider the point you made earlier about excess supply in some of these markets. So I think it will be very interesting to see. Maybe there are ways to convert these hotels to a higher value, better use in the long run. But here, I really think the last word hasn't been spoken, especially because the PPP program has resumed this spring rather. So I think we'll have to wait a little longer to see any more permanent shifts caused by this disruption.
This is not so much a question, but an observation, and that is that, you know, two things that I've seen in my own travels. Number one is there's a huge geographic dispersion right now. You go through airports in New York and there's nobody there, and you go through Charlotte and Atlanta and they are like Mardi Gras, right? There's people everywhere. And I think that will be seen. But another observation that we've discussed on our other podcasts is that, you know, when it comes to business travel, it's not the business traveler himself that determines the need. It's also, is there somebody at the other end of that flight that's willing to receive them? And if you're going someplace where you're expecting to, where there isn't a meeting to be had, all right, there isn't two to tango. And that could be part of the reason you see a slow recovery.
We've been talking about this in the last couple episodes ourselves. And actually today there was an article in the Wall Street Journal about hotels struggling to staff up after having let a lot of people go. Do you see any data or any anecdotal evidence that you can kind of talk to on that front? Are the operating costs of hotels going to increase significantly due to, you know, they need to raise wages to bring people back or do more cleaning or anything else like that?
So this is me speculating to some extent based on some information that I have, is that if you look at the kind of typical profile of somebody who works in the hotel industry, on the operations side, those tend to be jobs that have relatively lower wages. So those are sometimes jobs that go to segments of our population that are a little bit more vulnerable economically. And those are the same segments of our population that were also a lot more vulnerable to COVID-19. So I would expect that there is a lot of hesitation to go back to a crowded work environment where you potentially expose yourself to lots of travelers from different places, and that requires some compensation. And then there is a question about childcare. School has not fully resumed yet, so I think there are lots of obstacles at the moment.
Well, talking about places where we don't want to go, I certainly don't want to go someplace where they are skimping on their cleaning budget for sure. So if you find any research to that effect, you know, please let us know.
Actually, there is a paper by Sean Wilkoff and a co-author whose name escapes me now about cleanliness in Airbnb accommodation. And that was actually cited in The Economist not too long ago. So you should look that up. Maybe it can give you some ideas for where to go on holiday.
Is this a happy story or a scary story?
Nice. Sounds scary.
It's good economic work. So it's a fairly neutral story, but you can pick up some anecdotes that you might find helpful.
Excellent.
So Eva, we spend probably some good portion of our podcast time talking about macroeconomic factors and how they create potential risks for CRE investors. You've actually spent some time studying the link between credit market conditions and the performance of real estate securities. Give us your ideas of what is most concerning you now.
So I wouldn't say concerning, but there are two key metrics that I think people are watching now. And to me, those are job growth and inflation. Job growth as an indicator of the recovery in the real economy as pandemic-related restrictions are lifted, and inflation as, in a way, the potential blowback from the unprecedented level of economic stimulus that the government has made available to alleviate the hardship imposed by COVID-19. So on jobs growth, I understand that the most recent monthly numbers may not have been as strong as forecasts suggested and as we were hoping, but to me that is, as of now, less of a concern. I still see that as a blip, kind of simply reflecting that the recovery from this enormous disruption that was COVID-19 can't be a smooth, linear process. So I'm not too worried about that yet. On inflation, as a German, I should be stereotypically worried about prices spiraling out of control, but right now, I still think that the most recent spike, especially in commodity prices, is still going to be temporary. On this note, I follow researchers at Penn State at the Institute for Real Estate Studies regularly compile an alternative inflation index where they take into account the cost of housing in a different way, kind of linking back to our discussion of my paper on long-term real estate returns. They consider the cost of housing after adjusting for changes in the quality of the housing stock. So given that housing is such an important component of inflation, that gives you a slightly different, perhaps more accurate picture of inflation. But again, my conclusion from looking at this data is that the recent spikes, I hope, are likely to be temporary.
The spring semester just wrapped up, and we understand that class was virtual and online this past semester, I guess by choice of the professor, correct?
Yes, that is true. During the fall, the university administration gave instructors a choice whether they wanted to hold their spring classes online or in person. I opted for online, and we just finished our classes at the end of April.
And what does it look like for students returning in the fall?
Well, my understanding is that the administration plans a careful, gradual return to in-person instruction over the course of the summer sessions, and then they're planning to return to full on-campus programming in the fall. So clearly, happier days are ahead for our students.
Tell us a little bit about your Penn State program and what makes it unique and different and what's going on there.
Yeah, so one thing that's noteworthy about the program is that we have recently launched a master's program in real estate, which unlike some of the master's programs in real estate that seem to focus more on MBA type students, so those with more work experience, a few years out of their degree, we tend to admit younger students who maybe have a first degree in business, finance, economics, law, architecture, engineering, but are intrigued by real estate as a potential career choice. So we offer them a 1-year master's in real estate that they can use to hone their skills in those particular areas. There are 2 options that students can select into depending on whether they're interested in a more research-focused program of study or a more application-focused program of study. Now, of course, that program has launched just as we went into the pandemic, so the first crop of master's students may not have had the experience they were hoping for, but they coped absolutely admirably. They all placed very well. We're very proud of them.
The great financial crisis gave rise to a whole lot of different things in the commercial real estate segment, most notably credit default models and stress testing and so forth. Has this pandemic led you to start tearing up your old syllabuses and putting new things in there, or is it too early for that? Or has your student body changed the questions they asked? What's different now than it was maybe when you were at Cornell or maybe where it was a couple of years ago? Maybe nothing at all.
That is an excellent question. One of the things that is very interesting to me is the demand for density. So if you think about the typical model that rents are highest in the CBD because of higher density and greater supply constraints and the benefits of being close to other businesses in your field. Now with remote work being more generally accepted and more widely adopted, there is a question whether density will retain the same value that it used to. So this to me is an interesting question, kind of on the intersection between urban economics and real estate finance that I would like to think about more, and that I think we will be discussing a lot in our classes because it's something that students can relate to. But it is also a question of academic interest.
Madness. If the demand for density goes down, that's going to be bad for me, right?
That could be interpreted a couple ways.
Madness likes to say that I'm pretty dense, so
that's where I was going.
I don't need a lot of space personally, so you could stick me anywhere, but I would have to say I am dense as well from time to time, so the jokes often fly above my head for sure.
Well, not according to your questions and comments that I have witnessed today, which were excellent.
Well, for our listening audience, they can never see us. They can only hear us as we don't do this. But I could tell by the look in the professor's eyes that a couple of times I threw a few curveballs. And that is certainly my MO at times, much to my or our guests' surprise.
Well, of course, you can't just have scripted answers. It needs to be spontaneous, for sure.
We definitely go unscripted. With that, we'll close this special podcast. Thank you to Dr. Eva Steiner for Penn State Smeal College of Business, and thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Please visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.